Here is the absolute wildest paradox in tech right now. Imagine building a competitive moat so massive and so technologically complex that you essentially lock out every other company on the planet. You hold the literal keys to the artificial intelligence revolution, but maintaining that exact same moat is going to cost you tens of billions of dollars in a single year. That's the tension we're unpacking today. Wall Street knows this company is structurally critical to the future of technology, but they are absolutely terrified of the staggering cost required to keep it that way. And here's the number that's keeping analysts awake at night: $64 billion. That is Taiwan's Semiconductor Manufacturing Company's, or TSMC's, upper-end capital expenditure budget just for the year 2026. Keep in mind, this isn't revenue. This is just what they have to spend on new factories, advanced packaging, and research just to keep the lights on and maintain their lead. It's a massive financial weight. And to understand why a company would willingly spend more in 1 year than most of its competitors have spent in a decade, we really have to look at what they are actually achieving with that money. Look at this comparison because it brilliantly illustrates the brutal reality of the semiconductor market right now. This is a look at the leading-edge 3-nanometer manufacturing process. On the left, TSMC is hitting production yields of over 90%. That means 90% of the chips on a wafer come out perfectly functional. On the right, their closest pure-play competitor, Samsung, is stuck at yields hovering around 50%. This stark reality is exactly why major tech giants like Google, AMD, and Qualcomm have basically been forced to migrate their flagship chip designs over to TSMC. They are completely locked into this ecosystem because nobody else can execute at this scale without failing half the time. Now, what's truly fascinating here is the business model itself. TSMC operates as a pure-play foundry. They don't design, brand, or sell their own consumer chips. They don't compete with their customers. Instead, they act as this impartial, completely unavoidable utility. Think about it. Whether NVIDIA wins the AI race, or AMD takes market share, or Apple dominates mobile, TSMC wins, because they manufacture the silicon for all of them. They are essentially selling the pickaxes during the greatest gold rush in modern computing history. So what's actually driving this business today? Looking at their latest Q2 revenue breakdown reveals a massive structural shift. High-performance computing, or HPC, which includes chips for AI accelerators and data centers, now makes up a staggering 66% of their revenue. This segment surged 20% just sequentially. Smartphones, which used to be the crown jewel, are now sitting at just 22%. The entire growth trajectory of this company is now tethered directly to the global build-out of AI infrastructure. And this is where we start to truly understand the depth of their economic moat. It is incredibly painful for a customer to leave. First, you have these extreme switching costs. A single chip design and physical tape-out sequence at these advanced nodes costs a company between $50 and $100 million and takes up to 2 years. Second, TSMC has an open innovation platform with over 93,000 pre-verified IP blocks. Chip designers naturally default to TSMC because it simply maximizes their chance of getting the silicon right on the first try. And finally, TSMC completely controls the bottleneck for AI chips: CoWoS, advanced packaging. They achieve a value-add rate near 50% on these packaging lines, which locks those profits entirely within their internal ecosystem. Let's look out to the horizon and see how this builds. Why does this moat matter so much? Because according to TSMC's senior leadership, the total addressable market for semiconductors is projected to blow past $1.5 trillion by 2030. That is a massive upward revision from previous estimates, and high-performance computing is expected to command 55% of that pie. The runway for growth here is undeniably massive. But here is the central conflict. Here is the fear. We call it the weight of the armor. To actually capture that $1.5 trillion market, TSMC has to relentlessly invest. They're pushing into the new 2-nanometer node, they are building out the A16 process, and they're pouring billions into incredibly complex overseas fabrication plants in places like Arizona, Japan, and Germany. Wall Street is genuinely terrified that this intense capital requirement, combined with the higher costs of running those overseas fabs, is going to severely compress TSMC's profit margins. So let's look at the hard evidence from their latest earnings report on July 16, 2026. Honestly, the numbers were explosive. Net revenue hit $40.2 billion, up 33.7% year over year. Gross margins expanded to a massive 67.7%, blowing past their own guidance. And look at the bottom line. Diluted ADR earnings per share came in at $4.31. That is a massive 13.42% beat over Wall Street consensus estimates. By every traditional metric, it was an absolute blowout quarter. But the market's reaction revealed exactly where the anxiety lies. Management actually raised their full-year 2026 revenue guidance to over 40% growth. Yet, immediately following the announcement, the stock price actually dipped between 1.5 and 2%. Why the disconnect? Well, because management guided that gross margins for Q3 would moderate down to around 66%. The market looked right past that massive revenue beat and focused entirely on the fact that the steep ramp-up of 2-nanometer manufacturing is already starting to dilute near-term margins. And hey, real quick, if this kind of research-first analysis is your thing, you'll probably want to subscribe. Zooming out from the quarter-to-quarter noise, let's assess the overall foundation of the business. Based on our qualitative scorecard, TSMC comes in incredibly strong at 9.1 out of 10. Their financial health is flawless. They are a literal financial fortress sitting on over $110 billion in cash and marketable securities. Profitability is a 10 out of 10, with a 55.6% net profit margin. Their market position is totally unassailable right now, holding roughly 90% of the advanced sub-5-nanometer market. The only real drag on this perfect score is their business viability, which is an 8 out of 10, strictly due to the constraints of those overseas operations and the undeniable geopolitical risks, which we will touch on shortly. And by the way, all of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, quality businesses built to compound for years, hidden gems, under-the-radar names with asymmetric upside, and dividend hunters, durable income with the fundamentals to back it up. Portfolio Watch monitors your portfolio and flags important changes. Insider IQ tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of your screen. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. Okay, jumping back into the analysis, let's project this forward. But before we look at the numbers, I need to clearly state, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. So, what does a 5-year outlook actually look like for TSMC's US-listed ADR? Using our baseline price of $419.48, the model outlines 3 paths for 2030. The base case points to $568.39. The high case shoots all the way up to $914.90, and the low case drops down to $216.04. When you apply probability weighting across these scenarios, the blended 5-year target price sits at $584.55. But let's be real, a target price doesn't tell you anything without understanding the operations underneath it. So let's break down exactly what has to happen operationally for these scenarios to play out. In our 55% probability base case, we assume AI spending remains durable but moderates a bit. By year 5, revenue hits $292 billion. Crucially, net margins settle at 42%, which reflects the normal expected margin dilution from bringing those really expensive overseas fabs online. We assign a historical 24 times exit multiple, yielding a solid 6.26% annualized return. Now, in the 25% high case, generative AI workloads just drive massive, sustained demand. TSMC resolves its 2-nanometer yield curves way ahead of schedule, pushing revenue to $368 billion. If their strong pricing power pushes net margins up to 46%, and we apply a 28 times multiple, you're looking at nearly a 17% annualized return. But you have to respect the 20% low case. This assumes a major cyclical downturn in semiconductors. Hyperscalers pause their AI spending, we see overcapacity, and competitors capture market share. Revenue only reaches $205 billion, and because they've already spent so heavily on massive CapEx projects, those fixed costs completely crush net margins down to 34%. At a 16 times multiple, the stock contracts significantly. If you want to dive deeper into the exact year-by-year assumptions, remember you can access the full scenario model in the free report at flash.stocksentinel.ai. Now, hope is obviously not an investment strategy. We need to know what concrete, measurable risks could actually break this thesis. What are the early warning signs you should be tracking? In the short term, closely watch inventory turnover days, which currently sit around 87 days. If that rises sequentially, it could indicate delayed ramps or low yields at the new 2-nanometer node. In the medium term, pay close attention to CoWoS packaging lead times. Right now, they are stretched out an insane 52 to 78 weeks. If that lead time suddenly contracts, that's a massive red flag indicating that AI capacity is finally catching up with demand, or worse, that orders from major customers are actually slowing down. And long-term, watch for official press releases announcing major design wins for Intel's new process nodes. Speaking of Intel, we really have to address the competitive threat they pose. While Samsung is struggling, Intel Foundry is aggressively pushing into this space. They are reporting that yields on their new 18A node have already reached 85%. On top of that, reports suggest Intel is reclaiming up to 90% of the compute tile production for their upcoming Nova Lake processors, bringing it in-house and away from TSMC. And on the packaging front, Intel's EMIB technology is reportedly hitting 98% yields. If major clients like Google or NVIDIA start using EMIB to bypass TSMC's CoWoS bottlenecks, that impenetrable moat suddenly starts to look a whole lot more vulnerable. And of course, no analysis of TSMC is complete without addressing the geopolitical elephant in the room, the absolute concentration of their primary advanced manufacturing within the science parks in Taiwan represents a massive single point of failure. Any escalation of trade tariffs, military exercises, or blockades in the Taiwan Strait would completely blow up global technology supply chains and instantly impair this entire investment thesis. It is the ultimate tail risk. So let's bring all of this together. What should you actually take away from this? Number one, TSMC possesses unrivaled industrial utility. By operating as a pure-play foundry, they sidestep product obsolescence entirely and simply profit off the aggregate expansion of global computing power. Number two, Wall Street isn't afraid that TSMC will lose its dominance. They are terrified of the price tag. The $64 billion CapEx moat that keeps competitors out is the exact same weight that threatens to compress their profit margins over the next 3 years. And number three, the true risks are not necessarily demand-driven, but rather execution-based, like managing these massive global fab expansions and geopolitical, rooted squarely in the Taiwan Strait. Which leaves us with one final, pretty provocative thought. Will the sheer astronomical cost of building the physical infrastructure for the AI revolution end up crushing the margins of the very company responsible for building it? It's a tension that is absolutely going to define the semiconductor industry for the rest of the decade. If you want the full research, including the deeper framework behind this video, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.